and welcome to this week's webinar with me, David Jones, and Aondo Markets. So if you're watching the recorded version of this, it was held live on Wednesday, the 30th of August at 12:30 in the afternoon. So this is a webinar that we do every week on a Wednesday lunchtime, and there are two parts to this. Looking at the markets and major levels and trends to look out for. There's quite a lot been going on. We haven't done this for a couple of weeks, so we've got a bit of a catch-up to do today. But I think there's lots going on, and I think this week we'll include Bitcoin. That's not one we've looked at before, but I think that is becoming an ever-popular market, one I know nothing about. So we'll take a look at Bitcoin as well as the usual FX indices, commodities, oil, gold, that sort of stuff. But what we'll also look at in these webinars is a little bit of strategy. So today we are going to talk about position sizing. How big do you trade? Because I think it's something that most people get wrong in the beginning, at least anyway. And it's really important, I think, in the hurry to look at Fibonacci's and RSI's and all that stuff. People ignore this, so we'll spend a little bit of time talking about position sizing. I think that risk warning has been up long enough, so let's get started. Right, so what you should see on your screen now, this is the Aondo trading platform, TradeHub. So I don't know where to start. Let's start with the euro. Let's have a look at a couple of FX markets first, and then we'll have a little break, talk about position sizing, and then we'll look at other markets. So the euro trend that we have been talking about for much of the last few months, hang on, is that showing on the screens? Yes, it is, has continued. And just yesterday, we're out to the best levels since ages ago, isn't it? What's that, 2.5 year high on the euro. We're picking up, I think last time around, this whole 116, 117 area, the old highs from the second half of July 2015, as maybe being a problem for the euro. And they were a problem for maybe a week, but you can see it's just sailed through. So I think it's the same old really on the euro. Let me just zoom in on a bit more of a relevant bit. And I think we've just got to be a buyer of weakness. If we let's pick up on our trends in the euro. This is an incredibly strong trend, which I'm sure means that most people out there in the world of trading will be short the euro, because it's often the case. I'm sure I've mentioned it before. Some brokers give information as to who's long, who's short, and whenever you see a strong trending market, it's normally a reasonably safe bet that more than 50% of people, sort of from a retail trading point of view, will be the other way around to the trend. Let me just have a quick look. I'm just going to log onto my phone and have a quick look and see if I can pull that up. I would be very surprised if the majority of people were short. I'm guessing, they were long. Sorry, I'm guessing they're going to be short. Let's have a look. No, it's not coming up. Okay, but oh, here we go. So yeah, just with a broker, 71% of their clients are short the euro at the moment with another broker. You clearly, you've got to be a buyer in a market like this. I think the only question is, where do you buy? You could make the argument, right, in the short term, it's a market that's clearly overbought. We had that spiky push higher yesterday, and it's rejected those prices pretty sharply. The RSI, if you're a fan of the squiggly lines, the RSI has been overbought up here. The market sold off, pushed higher, overbought again, and the market has, for one day at least, sold off. But what we also have, we've spoken about this a bit in the past, haven't we? This idea of divergence, where the RSI is doing something completely different to what the market's doing. And this is a 10-day RSI I've got down here, and this is definitely the case. If you look what's going on here, the market's pushed to a high in July, sold off, pushed higher still, the RSI has made a lower high. So this is bearish divergence. So this is a suggestion that maybe the current strength is running out of steam. You can see it back here, the similar sort of thing back here, where the euro pushed to a high there, RSI overbought, euro pushes a little bit higher again there, RSI makes a lower high, and it did see the euro sell off for 3 weeks or so. So maybe we're due, a bit of a slide after this push to new highs, but we should see that as an opportunity, because if we pick up on the old levels, we've got big levels back here, 116.60-ish, and then another big level at 116. So for my money, oh, I've drawn that in the wrong place, well done. Let's flip it over to an hourly and we'll see it clearer. So for my money, you know, a pullback to here, if we do get the pullback, you know, back towards, well, even back to these old supports, you know, we've got a lot of support from over the last couple of weeks. Looks like a buying opportunity. So for me, I would not be calling a top in euro dollar just yet. You know, incredibly strong market and plenty of support if we do sell off back to those mid-August lows ahead of 116. You know, still be a buyer. So I think when it comes to targets for the euro, we've got to take this chart out a bit further now. Here we go. You can see this is a pretty major reversal that we're going through. You know, we had the market euro dollar spent virtually all of 2015 making this base pattern. Then we had this breakout to the downside, which ended up being a false breakout. We've gone zooming back up to these old highs. You know, I think we can have some pretty aggressive targets from up here. You know, maybe back into this 126, 129 zone from here. But that trend definitely up. So you know, it would suggest for most people that the right position to be in is to be buying on dips rather than trying to sell the top. You know, so we've seen a lot of euro strength. Let's have a look at the pound. The pound against the dollar. You know, this is another market. If we flip it over to the dailies, the trend for this year has continued. It's maybe not quite as impressive as euro against the dollar. You know, but we've gone from 120 up as high as what 132.5. So that's 10%-ish move, 10% recovery in the pound off those January lows. So let's just pick up some of the levels. Here we go. So if we plonked our trend in for the pound, it's going to look something like that at the moment. The longer term trend coming in around 125, but bigger support at 126. Support from a week ago about what 127.70. So I think this is another interesting one. You know, we don't have the same sort of momentum that we've got on the euro, but some people might take the view that the weakness that we'd seen for much of August in the pound against the dollar is over. You know, we've broken out of that downtrend that's been in place for a while. 129-ish had been a problem middle of August. We've broken that this week. So you know, it would tend to weigh it towards further recovery for the pound from here. And as usual, I think the question is going to be, well, where do you put your stop loss? For me, the tightest I would want it is probably just below these lows, so below 128.68. So that's, what's that, about 60-70 point stop loss from where we are now. That's the tightest I want it personally. You know, because this was the area it was dibbling around before it broke out to these old highs. So for me, you know, maybe a buyer here looking for a deeper recovery back up to here and a stop down there. I think if we see this level lost, it would be interesting to see what happens if the market, you know, dipped back down towards 128, and then I'd be looking at buying opportunity again with a stop under that low from August. And I think only if we see that August low broken does it invalidate like the bullish view on this hourly chart. So I think it's interesting. You know, I think FX markets never dull, are they? But some interesting moves there. I think pound against the US dollar and euro dollar. So a quick look at euro sterling. I must admit, I never look at this one very often, but let's just see where we are on euro sterling at the moment. See if we're in danger of a euro being worth a pound at any point in the future. I mean, it has, you know, again, it's broken out. We are seeing, you know, we're seeing dollar weakness at the moment, but we're also seeing actual, real euro strength. So this is euro against the pounds. You know, we had the old levels from almost a year ago now. Let me pick them up from up here. So the old highs around about, well, just ahead of 92, and we've gone through those. You know, so again, euro sterling, we want to be a buyer of euro on dips and a seller of the pound, you know, so maybe we will see parity. You know, we will see a euro end up being worth a pound. Let's take it back and have a look at the big picture. Here we go. So it's never quite got there, has it? So it's going to be interesting. I mean, there are some big barriers coming up. You know, we traded as high as, what was it, about 98-ish, way back in 2008. But at the moment, it does have momentum on its side. So we'll see what happens. But on the dailies at least, you know, that euro sterling, it's still an uptrend. You know, it's still a market that's still strong. So the euro definitely one to watch at the moment. Let's have a bit of a break and let's talk a bit about position sizing. So I'm gonna do my normal scribbles now. So let me just bring this up. Just bear with me a second. So hang on, is it there? Yes. Oh no, my clicking finger is out of practice. Right, hold on a sec. So position sizing. This is the bit that decides how big G trades. So let me bring up. Nothing works, does it, when you come back off holiday? There we go. Right. So most people trade too big. Let's say the average account size, to keep the maths easy for me, is £1,000 or €1,000 or $1,000, whatever it is. And most people get very excited. They log on, they start trading, and they might end up risking, I don't know, let's say 150 quid on a trade. So they might do a trade on euro dollar, 75-point stop loss, for example, 75-point stop, and then they'll do it £2 a point if they're spread betting, or the equivalent if they're doing contracts for difference. And they think, well, if the trade goes right, I'm going to make loads of money, and if the trade goes wrong, I'm only going to lose 150 quid. But 150 quid, if that is your trading account, is just far too big. You know, you only need a run of well, you don't need. Well, let's say you had a run of 4 losing trades, right? And I've had a very mediocre August after having a very good May, June, and July. August has been one step forward, 1.5 steps back, and I've had 4 losing trades on the trot in August. So if you have 4 losers, you don't need an A level in maths to see you are going to be minus 600 quid. So on just 4 losing trades, you lose 60% of your account. So I think it's going to do massive damage psychologically to you, and the problem is that you might be too nervous about taking what end up being good trades, and of course your account balance is down to 400 quid, so you have to double your account and more. You've got to have 150% return just to put yourself back to where you were at the start. So hopefully you can see that this is wrong. So let's go back. So let's go back to our 1,000 quid account. Now, most sensible approaches to risk management suggest you should only risk losing 1 to 3% of your account on any one trade. Now, this is something that people do not like to hear, because if you're only risking losing 1 to 3% of your account, it's going to take you a long time to turn your £1,000 into a Lamborghini. But it does mean, it gives you longevity. It means that no one individual trade matters. Let's say you're risking 3%. It means if any one trade goes wrong, it's only going to cost you 30 quid. And if you're trading on a risk reward of about 3 to 1, then hopefully your risk is looking like you're risking 30 to make 90. Yeah. So even if you have a run of 4 losing trades, if you have a couple of decent trades, it's going to more than make up for the risk. And I think psychologically, it's a much better place to be in, to be risking a relatively small amount of your capital. So you have a much more, I don't want to say don't care attitude to trades, but you're not obsessing and stressed out by every individual trade, because no individual trade matters. But people don't like hearing this because they think that trading is all about putting £1,000 in an account and doubling it every couple of weeks. There may be somebody out there who can do that, but most people won't, because they'll be taking on far too big a level of risk. Yeah. So what we want to do, however much money you have in your account, think about, well, how much am I going to risk on any one trade? And the methodology that has been around for decades is that sort of bracket is the right sort of thing to be aiming for. So it's not the bit that decides your stop loss. You might decide on a trade, right, I'm going to buy the pound at 129. That's not a very good 9. I'm going to have a stop loss at 128.40. The stop loss in that example is 60 points away. If I'm only allowed to lose 30 quid, then if with a 60-point stop loss, I need to trade the equivalent of 50p a point. Okay, if I'm spread betting, I can do 50p a point. or if I'm doing CFDs, I do the equivalent size that gives me an exposure of 50p a point. So it's one of these things. It doesn't take much to think about, and it only adds maybe 30 seconds to doing your trade to think about sizing your trade. But it's something that most people do, and as we know, most people lose. I think people will just jump in blindly, in my experience, and risk far too much of their account on any one trading idea. What we're trying to do, hopefully, is get rich quick slowly, not blow up spectacularly quickly, which is what we'll do if we're risking too much of our trading account. Okay, there we go. That's our little lesson for today. But it's very important. Do not bet thy whole wad, I think, is one of the golden rules of trading. So think about your position sizing. Let's go back to the markets. So we've done the euro. We've seen incredible euro strength. Let's do Bitcoin. So it's the debut for Bitcoin in the market outlook. I can't actually find it. Here we go. Bitcoin. I think this is interesting. I mean, when Bitcoin first came out, I remember talking about Bitcoin. I think it was about 2012, and I just thought, just utter rubbish, flash in the pan, and this is where we are now on Bitcoin. So I'm sure it was actually about $100 or whatever it was. Bitcoin was worth $100 back then, and now it's worth $4,500 a Bitcoin. So let's take a quick look at what's been going on with Bitcoin from a daily point of view, because of course you can trade this with Aondo. So let's, just this year, coming into this year, one Bitcoin was worth about $1,000. So we've seen the price quadruple since the beginning of the year. Near enough. I think it is a crazy market, isn't it? If we see a market that does something like this, it is something of a crazy market. But if you look at the chart, you could argue it's no different to anything else. It goes up, it goes down, it goes sideways. And we did have on Bitcoin, we had since the latest surge from July. So from July to the end of August, we saw the price double, and it's gone a little bit sideways since then. But let's flip it out and just have a look at the hourly charts, because we've had a breakout. Is it yesterday? Yesterday it started breaking out again. So it had the price of Bitcoin, had been capped by about, let's say, roughly $4,500, that mark. So 44.75 with the highs, and you could see had a push up in August, another one middle of August, another one end of August. Couldn't break that level, 44.75, and we've seen it broken today or over the last couple of days. So you could make the argument, well, it suggests the next leg higher for Bitcoin is underway. So where is it going to go? Who knows? But based on the previous strength, I mean, I think if you're going to trade it, I think you need to give it a bit of room to move around, based off the volatility. So that the absolute closest I'd want my stop if I was trading it now is below these lows, which are only the lows from the 28th of August, which is Monday. So below Monday's low, to see if this is a valid breakout. And see what happens. Maybe if you want to give it a bit more wiggle room, you're going to go here, and maybe back here, which is actually $900 away, but is only where it was a week yesterday. So I've never traded, but I think before the next webinar, I'll do a trade on Bitcoin, and we'll see how it turns out. So you can guarantee that this is going to mark the top in Bitcoin when I finally decide to remortgage the house and buy it. But it's interesting, it's broken out again. Clearly it's a market that's making more and more headlines, not just based off how much it's gaining all the time, but I think it's an interesting market if you fancy a bit of volatility now and again. Let's look at something a bit more traditional. Let's take a look at stock market indices. For me, the main focus is still stock markets, and I think we're seeing some really interesting moves in stock markets. This is the S&P 500. So I think when we last did the webinar a couple of weeks ago, we were all a bit worried about World War III kicking off, I think, with what Mr. Trump was saying, and I think that caused the sell-off. This is the S&P 500. So it was only earlier in the week the S&P 500 had hit fresh all-time highs. Then the tensions between North Korea and the USA started. The market sold off, but then recovered, and then we did see quite a bit of volatility. And we've had it again this week. If we have a look at just the last few days, we've seen again. This is I think it was a Sunday night trade when it opened on Sunday night, Asian trade on Sunday. I think the S&P sold off really sharply. Ended last week about 24.45, and yesterday, it briefly traded down towards 24.22. But look what's happened again. Whenever we see this US stock market get clobbered, the buyers just step back in. Now there's going to be a day when they don't, but so far, this is what we're seeing. And I think there's some really big levels to watch. Clearly, when we see it dip down to this sort of 24.18, 24.25 sort of area on the S&P, the buyers come back in. It is having a bit of a problem though with 24.55, but I think despite maybe the welcome volatility that we're getting now, if you look at the bigger picture, I mean it's nothing. Some of the craziest swings we've seen in the last couple of weeks, from a bigger picture point of view, it hasn't really changed that trend, and it's only a couple of weeks ago that we had fresh all-time highs for the S&P 500. So I think it's only if we start to lose 2,400 on the S&P, I think it's a pretty big level. It's the old highs from back here in March that held the market down for a good 3 months, and it's been really good support. So I think for me, 2,400, big level on the S&P, and until and if we see that broken, any weakness, I think, looks like a buying opportunity. So it's interesting market with all the political shenanigans that's going on. The DAX continues to do its own thing. So the German market really does, it's sort of just ploughing its own field a little bit at the moment. It was June when we saw the DAX make fresh all-time highs, and it's come off, and it's still coming off. Yesterday we saw it push to its lowest level since April of this year. So it's really still under some pressure. It'll be interesting to see how it gets on if it gets back down. Well, whether yesterday's lows, 11,850, hold the market up. But still, I think a pretty weak market, the DAX for now. And just one last one, let's look at the FTSE. The FTSE is living up to its boring reputation. So the FTSE is really where it was a couple of weeks ago, I think, when we were doing the webinar. But again, it's pretty obvious, what the big level is on the FTSE. If we look back at, these old lows around about 7,300, we saw again a sell-off yesterday into 7,300. The buyers came back out, lifted the market up. So I think, it's only if we start to slip below there do I think we get maybe a bit more accelerated selling. But then we've got big old support back here from April, around about 7,100. I suppose that sort of area. So, but I think that the market to watch, remains the US markets, the S&P 500 and the Dow. I think they're clearly going to dictate what the rest of the world's stock markets do. So I would be watching those. I think day by day, always interesting markets. And to wrap things up, let's look at a couple of commodities. Gold is interesting, so we'll do that one last. But oil, I think I spoke a bit about trading oil over the last couple of months, and I had a good run, because we had this great trend where we'd see the market sell off for maybe a couple of days and bang, it would take off again. But it hasn't worked. I was in an oil trade for like a couple of weeks and got stopped out of it yesterday because it started to slip. And I do wonder if after this run from oil, from sort of 44.5 up to 53.5, have we seen the latest recovery sort of run out of steam? So I think for me, at the moment, the bias for oil is maybe to be short. There we go. We can see you hit a high August 21st, then it struggled. It hasn't managed to break that high. We've just seen selling whenever it's getting back towards that old high, selling, and it started slipping below old support. So I think for me, at the moment, I'd be looking to maybe sell into strength when it comes to oil to see if we go back and maybe, revisit those lows from mid-August. So I think after having a good recovery, a good trend, a very tradable trend, it does feel like it's changed, I think, in the last couple of weeks for the price of oil. And then finally, gold. So for all of this year, I've been a gold bull, and it's pushed out again. It's had one of its sort of squirts out to fresh highs for the year. So 1,300-ish, 1,295, 1,300. Was a bit of a barrier, been a barrier for a while, since April. So we hit 12.95 in April, and we did have almost this repeating pattern: go up, sell off for a couple of weeks, go up, sell off, go up, sell off, bang, and this time we've pushed higher. So I think it's traded as high briefly as 13.20. So I think for gold, again, a bit like the euro, but not as strong as the euro. The trend is clearly up. I think clearly it's been driven by dollar weakness and again the ongoing, the North Korea stuff. But for me, any weakness in gold, if we got, the ideal place to buy is if we got back to here, back to the June lows, sort of the 1220 area. But at the moment, I don't think it's too ridiculous to be targeting these old highs from the summer of last year, wherever that is, up around about 1370, I think, up at these sort of levels. So let's just flip it over to the hourlies. Let's see what happens. Let's have a look and see if we can see any obvious big levels. And once again, we just had this quick surge, didn't we, where the market just moved quickly on the political news. Maybe it's a little bit overdone, but saying that, the RSI has dipped, on the hourly chart anyway, has dipped into oversold. So an aggressive trade, if you really fancied the price of gold to move higher from here, is be a buyer here with a stop under last night's low. That would be a pretty tight stop. Maybe, what's that? If you had a stop down here, $9 stop, $10 stop on gold. But maybe, and if it gets, it could take off again, but if we break these lows, then maybe we'll move more back into this sort of 1280, 1290 range and look for strength again. But based on the dailies, you can't really argue, I don't think, with the bullishness at the moment. We've broken what has been a big level for the past 4 months or so. So it's a pretty major break. So let's see how it reacts if it does start to sell off. But it does suggest that maybe for the rest of the year, we should see the price of gold move higher. So we will start wrapping things up now. So what I'm going to do, I think, clearly the markets are watching me, euro dollar, because of the strength, and also US stock markets, because of all the shenanigans we're seeing because of the political situation. So I think there'll be two to watch. This Friday is payrolls day, so we've got US unemployment numbers. Friday lunchtime is always a big one, so 1:30 on Friday, and then I think next Monday is a holiday in the US, so we could have maybe a bit of a volatile session Friday afternoon after the payrolls and ahead of the long weekend. So I think US stock markets are always a good one to watch when those numbers come out. But if you have any questions after this, you can drop me an email, david@tradeafter.com. Ayondo, I think, are maybe better known for providing services for people to follow other traders, and I've been blogging about a live account on my website, tradeafter.com, so you can read about that there. And you can follow me on Twitter. Well, I haven't been on Twitter, tweeted anything useful for weeks, so I'll start putting sort of charts and big levels out from Twitter, and that's @JonesTheMarkets. But we'll wrap things up there. Thanks for coming along to the resumption of the webinars after the holiday, and we'll do it all again this time next week, and think of another new strategy thing to cover. So that's it for this week. I hope you have a good week, and you can make it for the next week as well.